Hello everyone, my name is Nikhil Muga. Welcome back to this channel. In this video, we will discuss how technology will improve the credit risk underwriting process for NBFCs. The NBFC sector has witnessed a drastic shift in the lending landscape post-digitalisation. This sector has incorporated automation in its various operations such as customer acquisition, onboarding and verification. However, it is yet to fully embedded the same in the credit risk underwriting process, as many NBFCs are still dependent on manual assessment of the various aspects of this process, causing delays in the loan approval and enhanced risk of defaults and non-performing assets. Now let's first discuss what is credit risk underwriting. Credit risk underwriting can be defined as the assessment of the borrower's personal, financial or business information to ascertain the creditworthiness and possibility of failure in the repayment of a loan taken by the borrower. The process involves the verification of KYC documents along with the detailed assessment of the applicant's credit report on well-established benchmarks by the NBFCs. Now let's discuss what is the procedure for credit risk underwriting. The procedure for credit risk underwriting is consolidated to 5 C's, which are character, capacity, capital, collateral and condition. And now let's discuss them in brief. First is character. Character signifies the borrower's credit history, which starts accumulating once the borrower begins taking credit cards or loans. The banks report such transactions in the account history of the borrower. The banks further send this information to the credit bureaus to create credit reports, which some designated company use to calculate the borrower's credit score or the CIBIL score. The NBFCs consider this credit score and report to analyze certain key information such as foreclosures, late payments, bankruptcies. The NBFCs often set a minimum credit score requirement for the grant of a loan. Next is capacity. The second C in the credit risk underwriting denotes the capacity. The capacity can be described as the borrower's ability to repay the loan. The NBFCs determine the capacity of the borrower by calculating the debt to income ratio. The debt to income ratio is the percentage of the gross monthly income utilized to pay debts by the borrower. Higher the debt to income ratio signifies a lower credit risk, which is a crucial determinant for the approval of the loan application of the borrower. Third is capital. Capital includes the assets, savings and investments that the borrower is willing to utilize for the loan. The capital can be assessed to the balance sheet. The main objective of the NBFCs to consider this aspect is that investing the personal capital reduces the chances of default by the borrower. It further signifies the willingness of the borrower to take a personal risk for the sake of his business. Fourth is collateral. Collateral refers to the assets pledged for the repayment of the loan by the borrower. The NBFCs evaluate the personal as well as the business assets of guarantors along with the borrowers, as the borrowers act as an alternate source for the repayment of the loan. However, the type of collateral should depend on the type of loan required by the borrower. Last is conditions. The NBFCs identify the condition of the industry, business and economy. The financial institutions or lenders need to verify the requirements of the individual or entity. The verification involves ascertaining whether in future the condition will continue, improve or deteriorate. In addition, the lender would also ascertain whether loan proceeds will be used such as working capital, renovations, additional equipment, etc. Now let's discuss what is the need for technology in the credit risk underwriting process. The NBFCs felt the need to adopt the automated credit risk underwriting process for the following reasons. First is expectations of the borrowers. The traditional banks used to depend upon physical distribution methods and manual calculation of the credit scores for ascertaining the creditworthiness of the borrowers, which has been quite challenging for meeting the changing customer needs. The rising demands for fast online credit approvals are rapidly growing, which has compelled the NBFCs to revamp the credit risk underwriting process. Second is reduced back and forth client interactions. The current process requires emailing, scanning, and faxing financial information and supporting documentation. This can be a tedious and back and forth process. Customer-facing interactive portals can easily enable the digital capture of such information. One such example is Video KYC, launched by RBI in the year 2020. Third is unnecessary manual work. The traditional credit risk underwriting process involves a considerable amount of unnecessary manual data entry. It becomes essential for the NBFCs to leverage a portal that connects to the borrower's financial accounting package that must have an inbuilt feature of reading tax forms digitally. Fourth is delays in decisions. The manual generation of the financial spreadsheet is a time-consuming process that can be reduced by applying innovative machine learning technology in the credit risk underwriting process. Fifth is higher risk. The primary issue faced by the NBFCs during the traditional credit risk underwriting process is the ascertainment of risk in the loan applications of the borrower. The agents must check the application thoroughly to mark any errors that can cause credit risk in the future. which can be pretty troublesome for NBFCs officials. Last is pressure on cost and returns. The new participants in the market are facing challenging incumbent revenues and cost models. The traditional banking operations, legacy IT systems, and branch networks can be tiresome as fintech companies operate at much lower cost to income ratio. Now, let's discuss how technology may improve the credit risk underwriting process for NBFCs. Technology can improve credit risk underwriting in the following ways. First is reduced turnaround time. Consumers need a fast and efficient personal loan process in today's time. Earlier, the lenders had to undertake manual verification processes, which usually takes several working days to finish. As fintech firms have developed innovative technology, digital verification can be done digitally through video KYC, e-KYC, e-signing, etc., thereby reducing the turnaround time by almost 10 times. Second is better decision making. The credit score is considered as one of the most crucial aspects of credit risk underwriting or assessing the individual's creditworthiness. Therefore, this shall be done through an automated system. The end decision shall be based on the in-house proprietary algorithms at the time of evaluating an applicant. These algorithms must assess multiple elements of the borrower's credit profile like CIBIL, score, FOIR, loans taken, etc. Credit managers further use social score algorithms to strengthen their decision accuracy. The use of technology helps them get deeper insights into the applicant's spending behavior, lifestyle, employment, etc., resulting in faster yet wiser decision making. Third is enhanced scalability. Earlier, the NBFCs used to carry out the verification process by sending a designated agent to the geographical location of the borrower for verification before lending. Now, technology has enabled the lenders to verify the consumer's profile irrespective of their geographical locations by using tools like geotagging, e-KYC, and other online verification processes, thus helping them unlock the untapped credit market and scale. Fourth is increased inclusion. The traditional lending system solely focused on the credit score for deciding upon the loan application, which was a problem for the borrower who applied as first-time borrowers. This has sometimes led to the rejection of loan applications of the borrowers. However, digital lenders do not just consider credit scores but various other factors such as income stability and job stability. Thus, with the entrance of the digital lenders, first-time borrowers enjoy easy access to credit when they need it the most. In the concluding remark, it can be stated that to implement a sustainable business model in this cyber revolution, it is of paramount importance that all the processes and workflow are streamlined according to the changing dynamics of the market. The traditional credit risk underwriting process causes delays in the credit estimation, loan approval and releases. The time and the cost of processing each loan application can be reduced drastically by streamlining the credit risk underwriting process. Hence, automation processes could help in delivering immense improvement in the underwriting process. For more such update, please subscribe to the channel.